Hello everyone, this is Saptarihi and Siraj will be presenting on Barclays credit risk. What is credit risk? According to Basel Committee, credit risk is most simply defined as the potential that a borrower or a counterparty will fail to meet its obligation in accordance with the agreed terms. The Reserve Bank of India (RBI) has defined credit risk as the probability of losses associated with the diminution in the credit quality of borrowers or counterparties. Though credit risk is closely related with the business of lending, that is, banks, it in fact applicable to all activities of where credit is involved. For example, manufacturers, traders sell their goods on credit to their customer. The first record of credit risk is reported to have been in 1800 BC. The credit risk management process, it involved four steps. They are 1. Risk identification, 2. Risk measurement, 3. Risk monitoring, 4. Risk control. Now coming to risk identification. While identifying risk, the following points have to be kept in mind. All type of risk existing and potential must be identified and their likely effect in the short run be understood. The magnitude of each risk segment may vary from bank to bank. The geographical area covered by the bank may determine the coverage of its risk content. A bank that has international operation may experience different intensity of credit risk in various countries when compared with a pure domestic bank. Also, even within a bank, risk will vary in its domestic operation and its overseas arms. Risk measurement. Finding out and understanding the exact degree of risk measurement in each category in the operational environment. Directing the efforts of the bank to mitigate the risk according to the vulnerability of a particular risk factor. Taking appropriate initiative in planning the organization, future trust areas and line of business and capital allocation. The system of techniques used to measure risks depend upon the nature and complexity of a risk factor. While a very simple qualitative assessment may be sufficient in some cases, sophisticated methodological and statistical may be necessary in the other for the qualitative value. Risk monitoring. Assessing the risk profile techniques regularly to examine how far they are effective in mitigation risk factor in the bank. Analyzing the internal and external audit feedback from the risk angle and using it to active control mechanism. Segregating risk areas of major concern from the other relatively insignificant areas and exercising more control over them. Putting in place a well-drawn out-of-risk focused audit system to provide inputs on restraint for operation personnel so that they do not take needless risk for short-term interest. Credit risk management. Maintaining risk return discipline by keeping risk exposure within acceptable parameters. Fixing proper exposure limit, keeping in view the risk philosophy and the risk appetite of the organization. Handling credit risk both on an entire portfolio basis on an individual credit transaction basis. Maintaining an appropriate balance between the credit risk and the other risk market, operational risk, etc. Placing equal emphasis on the banking book credit risk, for example, loans and advances on the bank balance sheet or books, trading book risk, securities, bond, and off-balance sheet risk, example, derivatives, guarantees, etc.
Hello everyone, this is Siraj and I will be explaining about Barclays. So it is a world leader in the financial sector. They lend, invest and protect money for more than 50 million customers in 50 countries. The service include personal and corporate banking, credit cards, investment banking, wealth and investment management services across the Europe, Asia. Africa, and United States of America. They offer world-class integrated corporate finance and investment banking solution. They deliver banking solution across all key industry sector through a team which is armed with deep understanding of day-to-day challenges and longer-term sectorial opportunities. So next we move on to loans and advances to the customer by the industry. As you can see, in 2009, the home loans have been decreased by around 20%. It was around 149.1, and in 2010 is it is increased by 20%. It was previously 149, and in 2010 168. And you can see the financial institution is decreased, and these all are you can see the loans and advances to the customer by the industries. The next bar graph is telling about total write-off of the impaired financial asset. As you can see, the 2007, 2008, 2009, the total write-off impaired financial asset have been increased, and 2007 it was like 1963, and 2010 it was like 4310. So let's move on to geographical analysis of loans and advances to the customers given by the industries. There is no much difference between 2010 and 2009. Both are more or less equal. The geographical analysis, like the countries like UK, EU, other EU means European Union, US, Africa, and the rest of world. You can see here there is no much difference between 2010 and 2009. Let's move on to overview of the Barclays Group credit risk exposure. Credit risk is a risk of suffering financial losses should any of the group's customer, clients, or market counterparty fail to fulfill their contractual obligation to the group. The credit risk that the group faces arises mainly from the wholesale, retail loans and advances, together with the counterparty risk arising from derivative contract entered into with clients. Other sources of the credit risk arise from trading activities, including debt security settlement balance with market counterparties available for sell assets, and reverse purchase agreement. Loss arising from exposure held for trading, like derivatives, debt security, are accounted for as trading losses rather than impairment charge, even though they fail in value, causing loss may be attributable to credit deterioration. And the next is analysis of the group's maximum exposure to credit risk. Financial asset recognized on the balance sheet, the exposure to credit risk equal to their carrying amount. For loan commitments and other credit related commitments that are irrevocable over the life of the respective facility, the maximum exposure to the risk is full amount of the committed facilities. The group's maximum exposure to credit risk is carrying value of asset, or the case of balance sheet item, the amount guaranteed, committed and accepted and endorsed. In most cases, the likely exposure is far less due to collateral, credit enhancement and other actions taken to mitigate the group's exposure. The next is Barclays Capital. Barclays Capital is the investment banking division Barclays Bank PLC with a distinctive business model. Barclays Capital provide large corporate and government institution clients with a full spectrum of solution to the strategic division, financing and risk management need. Barclays Capital has offices around the world, employs over 23,000 people and has global reach. advisory service and distribution power to meet the needs issuer and investors worldwide. Thank you.